Chapter 15. Financial Decisions and Risk Management. This chapter begins with a discussion of the objectives and responsibilities of the financial manager. Then, reasons are given why businesses need funds, short and long-term expenditures. The sources of short-term funds are noted: trade credit, secured short-term loans, and unsecured short-term loans, as are the long-term sources of funds, debt and equity financing. Securities markets are also described. Topics covered include the operation of stock markets and stock exchanges, buying and selling securities, financing securities purchases, short selling, mutual funds, and stock options. Financial management in small businesses is also examined. The chapter concludes with a discussion of risk management, and describes the 5 steps in the risk management process. The learning objective of today's lesson is that at the end of this lesson, you will be able to describe the responsibilities of a financial manager, distinguish between short-term, operating, and long-term, capital, expenditures, identify 3 sources of short-term financing for businesses, identify 3 sources of long-term financing for businesses. You will also be able to discuss the value of common stock and preferred stock to stockholders, and describe the secondary market for each type of security. Explain the process by which securities are bought and sold. Describe the investment opportunities offered by mutual funds, hedge funds, commodities, and stock options. Explain how risk affects business operations and identify the 5 steps in the risk management process. The role of the financial manager. Finance involves 4 key responsibilities: determining a firm's long-term investments, obtaining funds to pay for those investments, conducting the firm's everyday financial activities, helping manage the risks that a firm takes on. Financial managers plan and control the acquisition and dispersal of a company's financial assets. The overall objective of the financial manager is to increase the value of the firm, thereby increasing shareholder wealth. The responsibilities of the financial manager fall into 3 general categories: cash flow management, financial planning, and financial control. Cash flow management. Financial managers must ensure that the firm has enough funds on hand to purchase the materials and human resources it needs to produce goods and services. Financial control. This is the process of checking actual performance against plans to ensure that the desired financial status occurs. Financial planning. A financial plan, describing how a firm will reach a desired financial position, requires knowledge of what immediate funds are needed, when more will be needed, and what are the sources of these funds. Financial managers must know why their firm needs funds and be able to assess the pros and cons of potential sources of funds. Why businesses need funds. Short-term, operating, expenditures. These are incurred through everyday business activities and handled through careful attention to the following 3 areas. 1. Accounts payable. This is the largest part of short-term debt for most companies. Good management means purchasing sufficient supplies in a timely manner but withholding payment as long as it can without jeopardizing its credit rating. 2. Accounts receivable. Financial managers need to project both how much buyers will order and when they will pay. Credit policies are set in order to set payment terms and make payment times more predictable. Credit policies. These contain the regulations governing a firm's extension of credit to customers. 3. Inventories. Inventory management is critical. Stockouts can result in lost sales. Surplus costs the firm money in production, storage, and a risk of theft, damage, or obsolescence. Inventory could include raw materials, basic supplies, unassembled product, work in progress, goods being manufactured, and finished goods, goods completed and awaiting sale. Therefore, they all must be kept at appropriate levels. Long-term, capital, expenditures. These are used for fixed assets. They differ from short-term expenditures in that they are not normally sold or converted into cash. Their acquisition requires a large investment of funds, and they represent an ongoing tie-up of company funds. Sources of short-term funds. Short-term funds allows firms to cover operational expenses and implement short-term plans. Trade credit. Trade credit describes the granting of credit by a seller to a buyer. The types discussed include open book credit, a promissory note, a trade draft and a trade acceptance. Open book credit is when the sellers simply ship goods on credit, expecting that payment will follow. Promissory note is when buyers sign a promise to pay agreement before merchandise is shipped. Trade draft is when the buyers sign a statement of payment terms attached to merchandise by the seller. Secured short-term loans. These require the borrower to put up collateral, such as inventory as collateral and accounts receivable as collateral. The interest rates are usually lower for secured loans than for unsecured loans. This type of loan appeals to firms whose credit rating is not sufficient, or who are too new, to qualify for unsecured loans. Unsecured short-term loans. Although no collateral is required, the borrower must maintain a compensating balance. This type of loan usually occurs within an established relationship with a bank and often takes the form of lines of credit or revolving credit agreements. 1. Lines of credit. This is a standing agreement with a bank to lend a firm a maximum amount of funds on request. 2. Revolving credit agreements. This guaranteed line of credit from a bank requires the firm to pay a commitment fee as well as interest on funds borrowed. 3. Commercial paper. A company can raise short-term funds by selling unsecured notes for less than face value and then repurchasing them at face value up to 270 days later. Sources of long-term funds. These may be from outside the firm, debt financing, or within the firm, equity financing. Debt financing. The two primary sources are described, and their usefulness and drawbacks noted. 1. Long-term loans, usually a loan from a bank extending for 3 to 10 years. They are also available from credit companies, insurance companies, and pension funds. 2. Corporate bonds. A promise by the borrower to pay the lender an amount of money on the maturity date. Advantages. Interest on the debt are tax-deductible. Disadvantages. Firm may have difficulty finding a lender for extremely large loans. The firm may have restrictions placed upon it during the loan. Bonds. A corporate bond promises the holder a certain payment on a certain date with stated interest payments in the interim. This is the major source of long-term debt financing for most corporations. The bond indenture spells out the terms of a bond, including the amount to be paid, the interest rate, and the maturity date. Unsecured debentures are not backed by any security and only sold by financially strong corporations that carry lower risk for investors. Bearer coupon bonds is when holders clip coupons from the bonds to receive interest payments. Anyone with the coupon can redeem it. Registered bonds are certificates where it is only of value to registered holders. Callable bonds. The issuer of callable bonds may call them in and pay them off before the maturity date at a price stipulated in the indenture. Serial bonds. With a serial bond, the firm retires portions of the bond issue in a series of different preset dates. Convertible bonds. Convertible bonds can be converted into common stock of the issuing company. Equity financing. Sometimes this means the founders increase their personal investment, but, more typically, it means issuing stock or retaining the firm's earnings. 1. Issuing common stock. This type of stock pays dividends, which are not tax-deductible for the corporation, unlike interest paid on bonds. The differences between book value, par value, and market value are described. 2. Retaining the firm's earnings. This means less need to borrow money and pay interest costs, but also lower dividends, Therefore company stock is not as attractive to investors. Common stock. Market value is the current price of a share on the secondary securities market. Book value is shareholders' equity divided by the number of shares outstanding. Par value is an arbitrary value set by the company's board of directors and stated on stock certificates. Hybrid financing, preferred stock. Like bonds, preferred stock has payments for fixed amounts, but unlike bonds, it never matures and can be held indefinitely. No dividends need be paid if there was no profit, and when dividends are paid, preferred stockholders are paid before common stockholders. Choosing between debt and equity financing, the mix of debt versus equity provides the capital structure of the firm. A wide variety of mixes are possible. Financial plans usually include a target for the debt-equity mix. Equity is expensive, but the company has no formal obligations to the shareholders. Debt is cheaper, but the company may not be able to service the debt.